Welcome to The Explainer. Today, we're investigating a pretty fascinating financial mystery. We're looking at a massive, highly profitable, cash-generating machine of a company that is somehow flying completely under the radar for most investors. I'm talking about CF Industries. They're the world's largest producer of ammonia, and what we're about to uncover might just completely change how you look at the heavy industrial sector.
Okay, let's dive into this. The central tension here is just palpable. CF Industries is essentially printing money. They operate with massive scale, and they actively reward their shareholders. Yet the broader market seems to be totally ignoring its underlying strength, basically treating it as a volatile cycle peak story rather than the durable powerhouse that the data suggests it actually is. So why the huge disconnect? Well, the size of that disconnect sits at about 15%. At the time of this analysis, CF Industries stock is trading right around $106.50. But when you actually run the numbers, factoring in its free cash flow, earnings, and peer valuations, its blended intrinsic value is actually closer to $123. That highlights a massive asymmetry between its current price tag and its true underlying worth.
To solve this mispricing mystery, here's our roadmap for The Explainer. We'll start with 1, the ammonia giant's valuation, then look at 2, how CF makes money, 3, the financial powerhouse, 4, clean energy optionality, 5, the biggest risks, and finally, 6, the final verdict. Let's get right into it.
Section 1. The ammonia giant's valuation. Digging into the discount. Now, what's really interesting here is just how incredibly cheap the stock looks across the board. You've got a trailing PE of 11.2, which is well below its 10-year median. The EV to EBITDA is sitting at a heavily discounted 5.1 times, especially when you compare that to peers who are trading up in the 7 to 9 range. But consider PEGI for a second. That's the price-to-earnings growth adjusted for dividend yield. At 1.7, when you factor in a modest growth rate and that 2.5% dividend yield, the stock is showing some highly favorable value. And that 10.9% free cash flow yield? Yeah, that's the engine driving literally everything we're about to discuss. Section 2. How CF makes money. The simple but effective business model.
So CF Industries basically operates on a very straightforward 3-step model. First, they buy cheap North American natural gas. Second, they convert that gas into ammonia using the Haber-Bosch process. And third, they upgrade that ammonia into various nitrogen fertilizers and ship them out globally. What you've got to remember here is that this product is entirely non-discretionary. Farmers absolutely must have nitrogen to grow food. It's definitely not some shiny new AI app, but global demand isn't going anywhere. In fact, it's structurally growing.
So, the crucial point is this. Natural gas makes up about 70% of the cash production costs for ammonia. Because CF operates primarily in North America, they pay around $3 per million BTUs for natural gas. Meanwhile, their European competitors are paying anywhere from $8 to $15. This structural geographic cost advantage gives CF a massive economic moat. They can produce a ton of ammonia for roughly $200 to $250, while the Europeans are paying double, sometimes even more. They essentially set the global price floor.
Section 3. The financial powerhouse. Cash flow and capital returns.
In fiscal year 2025 alone, CF Industries generated a staggering $1.79 billion in free cash flow. This right here is the lifeblood of the investment thesis. And what really sets this management team apart is their extreme discipline. They aren't out there engaging in ego-driven empire building or reckless acquisitions. Instead, they take this absolute mountain of cash and directly reward their shareholders.
Just think about their aggressive share buyback program. In 2024, they repurchased 18.8 million shares. In 2025, they bought back another 16.6 million. They're effectively shrinking the total share count by about 10% a year. Why does this actually matter to you? Well, because even if the stock price stays completely flat, your individual piece of the earnings pie is getting significantly bigger every single year.
When we model this all out, the asymmetry of this investment becomes remarkably clear. In a bear scenario, where prices trough and things generally go wrong, intrinsic value sits around $80. That's roughly a 22% downside from current levels. But in a base case, you're looking at $123. And in a bull cycle peak, you've got a massive upside potential to $157. So you have very limited downside compared to some incredibly substantial upside, which creates a highly compelling risk-to-reward ratio.
Section 4. Clean energy optionality. The plot twist for the 2030s.
Let's move to and see how this builds into an unexpected catalyst that the broader market is honestly completely missing right now. CF Industries is quietly pivoting toward the future.
They're building a joint venture called Bluepoint, which is expected to be operational around 2029. This facility will produce low-carbon ammonia, which basically acts as a premium clean energy hydrogen carrier specifically targeted for Asian markets. Combine this with the 45Q carbon capture tax credits, which essentially pay them to trap emissions, adding about $100 million a year to their cash flow. And suddenly, CF shifts from being a standard fertilizer cyclical into a future-proof clean energy play. It's a real game changer.
Section 5. The biggest risks. What could break the thesis?
Now, to keep things balanced, there are 4 main risks we need to monitor here. First, if China drops its current restrictions and resumes massive urea exports, it would totally flood the market and depress global prices. Second, if U.S. natural gas prices spike, maybe driven by aggressive LNG exports, well, CF's cost advantage shrinks. Third is purely operational. An outage at their Yazoo City plant is costing them $200 to $300 million in earnings through late 2026. And finally, any unpredictable shifts in U.S. tariff and trade policies can directly impact both their raw material costs and their export capabilities.
Section 6. The final verdict. To buy or not to buy?
The absolute most compelling takeaway from all this data is this. CF Industries doesn't even need a fertilizer boom to be a great investment. If they simply maintain their $1.5 to $1.8 billion in annual free cash flow, and management just keeps aggressively buying back stock at these depressed valuations, a 9% annual return target is practically built into the current $106.50 price over a 5 to 12-year holding period.
And this brilliantly illustrates how legendary value investor Charlie Munger would categorize this stock. Sure, it lacks a flashy, hyper-growth tech narrative, but it has a durable, unshakable structural moat, incredibly disciplined capital allocation, and a truly shareholder-first management team. It is, quite simply, a good business selling at a very fair price.
So I'll leave you with this final thought to ponder. In a market that seems totally obsessed with chasing the next expensive tech trend, does a highly profitable, cash-flowing, heavily discounted cyclical giant like CF Industries belong in your portfolio to provide some real balance? It's a hidden gem producing something the world simply cannot live without. Thanks for joining me on this explainer. Keep learning, and I'll catch you next time.